Morning all, this is George, and we are just about on 11 GMT, so we can get started. Just want to confirm again that you can hear me satisfactorily, volume and so on is okay. Perhaps you could just put a little note in the chat box and let me know if that's okay, and thank you very much indeed all. Right, well, good to see you in the room, and here we are. It's very early January. In trading terms, it seems that it's been quite a long month so far, a long year. We've had we're in the third day of full activity, and of course we can look back now over what has happened in the final part of 2014, and just see if get some idea if things are going to keep on moving in the same way that we have seen a high degree of volatility. Is that high degree of volatility likely to stay with us? Well, what we're going to do, just going to look at one or two things that work, one or two things that actually probably don't work quite so well in the markets. But also, we're going to have a little meander back and just look at some of the main themes. And of course, we've got plenty of those that we can look back on. So good to see so many of you in the room. Edward, Mohammed, Man, Pitman, Steve, Vidswanath. Yeah, just notice you sort of come through on the emails there. Manoj also, and of course Adinda. Right, well, let's go and look at some of the longer term charts, and it is very much the longer term. That should have switched quite over now. You should see a matrix there of a dozen charts, and they're all monthly charts. So, indeed, Mohammed, and a happy new year to you. Good to hear from you. Good to hear from you. Hope all's well. Now, one of the main themes that we've had is this chart. It's the dollar index. Now, this is a monthly chart, as we can see. If we look right way back to 95, there was this big rally that took us up to just after, well, year 2000, 2001. And, you know, those of us who were actively trading at that time will know that that was when the tech boom in the States really took off. And of course, it was sucking in an awful lot of worldwide money to participate in that boom. And then, of course, we get the crash, and the whole thing just evaporated. It was froth. It was all sort of hot air, the tech boom. And what did we find was that the stupid valuations that were put on so many of these companies that just sort of had internet or sort of tech or programming in their title, it was found that a lot of these companies were indeed just worthless. They were paper shells. And of course, we then get the collapse that ran on down with the culmination of the disaster that befell the world with the crazy situation with CDSs, credit default swaps, etc., based on anything that moves, based on any amount of debt, any crazy bit of debt that could be then packaged up very neatly and sold off to banks. And as we know, the whole thing just collapsed in a big way. Now, that did give, as we can see, it did give a temporary move with a panic into the US dollar, being a strong currency and also, of course, the safe haven of US treasuries, bonds, etc. Since then, the dollar has gone absolutely nowhere, and we've got this period now, or at least we have had this period of a beautiful triangle setting itself up. Now, triangles eventually will reach an apex, and they tend to get tighter and tighter and tighter, and as we can see, we eventually will get a breakout. Now, the breakout we've seen has given it quite a dramatic move on up. And if we look at the distance that this has traveled so far, and if we just put this in big round numbers, we've got 80 to 90. And we can see that previously the boom that went, the boom in the US dollar that went from 95, which lasted, okay, the best part of sort of 5.5 years or so, actually went from 80, much the same level that it actually started off on the current boom, and it went all the way up to 120. Well, is it likely to do that again? Well, it could happen. Is it likely to move into a halfway house, which is in this region of 100? Yeah, one imagines that that is highly likely that it will actually do that. Now, we've just had this boom going on now, and we've had this going on for about 7 months. So what about previous 7-month runs? If we look back over here, then we can see quite a number of runs, but generally, in fact, we've got quite a reasonable one just here. 1, 2, 3, 4, 5, 6, 7, and then there was going to be a correction. So if we just suggest that this current uptrend is going to follow previous dramatic uptrends, then the prospect of 7 solid months, higher after high after high after high, it suggests that we are going to get a correction at some point, and that correction could possibly be imminent. Now, there's a saying in the on technicals that when price starts to move up to a previous high, then that's the most likely place that we're going to get a pause coming in. And so that's exactly, well, I say exactly, it's in the region. We'd better put another line across just to pick out the high. So we've got a nice little region where we are most likely to get some form of a correction, because we've got a previous resistance here. We've got 2 lumps of previous resistance, and we've actually also got a support area going right the way back to 98. So are we looking forward to a move that should just carry on up? Should we wade into the US dollar right now, and expect this to move right the way up to 100? Well, I think we've probably got to be a little bit cautious, because we have had a big run. And based on what I've just been mentioning, then we are highly likely to get a correction coming in. Now, trends run, and they can keep on running for a period of time. But we've always got to keep in mind that when there is most optimism about, when most people are talking about a particular market carrying on forevermore, then that's exactly the time that people will be selling into strength, because there will be a lot of traders, hedge funds, banks, etc. out there who have done exceedingly well out of this rally and will be sitting on massive paper profits and could just be ready to go and take some of those paper profits. So that's the backdrop then of the dollar index, and let's just look at the other side of this coin, which is the euro. Now the euro has been doing more or less what that dollar index has been doing, but of course it's an upside downer. We've got this upside down chart where we're looking now at a breakout of this entire move. Again, let's just use a line where price currently is. And what we can see is that we've had something of a breakout, but there is still a low from where it needs to break. Now it's dropped down below that emotive level of 120, and ultimately we may well find that it's going to break through this next band of strong resistance and come right the way down to parity, right the way down to 1-to-1 with the US dollar. And of course, what's fueling all of this at the moment? Well, on the dollar side of the coin, we're seeing that the US economy is actually recovering at a greater rate than other world economies, most notably the Eurozone, which is struggling like crazy. And if we just sort of look back in history, what is Europe made up of? Well, it's made up of Germany, the powerhouse of Europe, and pretty well every other constituent member of the Eurozone traditionally have struggled to maintain reasonable growth. They always have. I mean, it's going back decades, absolutely decades. So if you then get a situation where Germany, for all sorts of reasons, is starting to struggle, then consequently we're finding then that the euro as a whole is on a bit of a sticky wicket, and we may well find that just purely based on relative economics, then the euro should be destined for much lower levels. Now, all of that said, there are umpteen other factors coming into play, and one of the main ones is Mario Draghi's suggestion that there is going to be more and more and more QE, or a variation on QE, with more sovereign bond purchases, etc., in order to pump more money into the banking system. And there are those who just might hope that it's actually going to get down into the real economy. That is, in workers' pockets and in their pay packets, so they can spend more and get the growth thing going again. So, I mean, there's a certainly Pan. No, I don't think he has actually done anything yet, though, and the market has anticipated that he will. So if there was massive QE, then we would get this chart absolutely collapsing on the downside. We have seen a run in the last month, couple of months, and it's all based on an assumption. So if that assumption doesn't actually come through in the next couple of months, what's that likely to do to the euro? Let's also throw in what is exercising a lot of commentators at the moment is the Grexit. Now, Greece, as we know, is struggling like absolutely crazy, and of course they have decided to call an election on the what is it? Is it the 25th of January, 25th of this month? So not far away, and there is a possibility that whichever government, whichever party gets in and attempts to form a government, what they will actually do is to say, right, enough's enough. We're going to sort of, we're not going to sort of, pay any more money. We're going to default, etc. And we're even getting noises out of Germany suggesting that, yeah, okay, well, we can let them go. Our banks will actually survive. So if that were to happen, then we just might find that the euro, could it become stronger as a result of that by allowing the poorest man in Europe to just drop out of the club, and they don't actually indulge in all of this massive bond buying QE that the Germans are really saying, no, they're saying nine. We don't want it to happen. So perhaps that just might be ready to actually strengthen this. Now, as correctly said, Morgan, you're so right there with saying that a strong Deutschmark would hit BMW, and consequently a strong euro hits BMW when you've got the likes of the Japanese just allowing their currency to collapse. So, yeah, Germany has done exceedingly well out of the euro. And there are those who are saying that because they have done so well out of the euro, they need to do an awful lot more to try and get growth throughout Europe. But is it likely to happen? I am very, very skeptical, based purely on history. Right, so there we are. We've got a potential two-way bet there. Now, let's just have a little ponder on cable, because I think we've got a fair number of Brits in this room, or at least people who are based in the UK. And what's going on here with cable, well, it's collapsing. Look at that nice little run up to 170. Bears out the theory that there is most likely to be a correction or indeed a reversal at previous highs and areas where there have been previous lows. So we've got a support level, we've got resistance level. Oh, it collapsed. So what about now? Are we going to see then cable move right the way on down and break through this pattern? It's getting close to one of these important support areas again. In fact, it's just pushed through one, but then we've got the emotive 150 level, and that 150 level is just sitting there waiting to be touched. Of course, politically, the UK is in the silly season again. We've only got, what have we got? 3 months to a general election, which is going to be almost certainly have some form of indecisive outcome, and consequently, that's rattling the market. We had the debacle over the Scottish referendum, and it appears that our economy in the UK is probably not quite on such a sound footing as the Conservatives would have us believe. The amount of growth, yeah, seems to be coming on nicely, but regrettably, debt seems to carry on. So over then to the Aussie. Now, the Aussie has reached more or less the level that the Reserve Bank of Australia wanted. And they were talking about having an exchange rate with the US dollar around about the 80 mark. And lo and behold, what have they got? It's around the 80 mark. So just look at this little band we've got running across here. We've got a previous low, potential support. We've got previous highs, potential support. That goes right the way back to, well, very late 96. So are we now ready for something of a bounce? It's starting to look increasingly likely. Now, we can look at one or two other markets, and let's just ponder for a moment on what is going on with the USD JPY. So the interesting thing about the USD JPY is that there was the reduction in QE by the US. And at just the time that they were announcing that, or at least that it was coming on stream, what did we find? We found that the Japanese actually picked up the banner and massively went into a bond buying spree, which then releases money into the banking system. And lo and behold, what has happened to that money? Has it actually gone into the Japanese economy and the average Japanese in the street? Well, probably not. The majority of it seems to have gone overseas and is chasing all sorts of higher yielding things that they can possibly get their hands on. But it's had the effect on the currency. What of now? Are we going to see this moving right the way up to the 130 level, where eventually it will probably move? Or are we reaching now an area where it's going to find some resistance? And once again, that's the suggestion that I'm putting forward here. We've got previous highs. We've got a whole series of previous highs above this sort of 120, 121 level. And we're now seeing the evidence that it is starting to come off somewhat. So what I'm really suggesting with all of this is that we have had some absolutely amazing trends moving on up. Is it now time for us to start to see some form of correction coming back down? Now, let's just consider one other little factor here, and that is this chart of the gold price. No, sorry, of the oil price. Now, technically, when you get a strong move, as we've had a strong move down there in '08, following the Goldman-inspired manipulation to push the oil price higher, followed by, of course, the bust, we then get this long period of sideways movement, and then we get the down move. And technically, if we were to just consider for a moment the standard ABC type pattern, where we get a move that runs from a high to a low, and then we consider that the next move on down will move the same distance. Now, if we were to look at this chart and suggest it's going to move the same distance down, well, it actually goes less than zero, which is slightly unlikely. So I think just for the moment, we'll remove that. But what we do know is that we've had the collapse. Will it go any further? Well, it's dropped under, again, an emotive number, which is 50. And I think what came out of OPEC, or was it the Saudi oil minister? I forget who it was, who said that it's going to keep on going down and it could go lower than $45. What was the reason for this? Well, there are plenty of theories out there, which I think I probably shared with the majority of people in this room today. And of course, one of them was that Obama got together with the Saudis, who put pressure, well, I say pressure, told OPEC what they were going to do, and they just wanted it to collapse in order to really make a mess of the Russian economy because of Ukraine. And you know, believe that one or believe it not. The other theory, of course, is that what was concerning the Saudis and OPEC was what was concerning OPEC was the rise in the amount of oil and gas production going on in the US with shale, with fracking, etc. So they decided that as they were the lowest cost producer, they could just flood the market with oil and consequently knock out all sorts of shale production, all sorts of high cost fracking and so on. And no doubt we will see in the next few months, if this oil price fall does continue, we are going to find that a number of sort of quite high profile companies in the States will just go to the wall because they're all highly geared. They are all very, very highly geared, and they all need an oil price above 100. I'd say all of them, the majority of them, do need a high oil price in order to maintain the research and development that has to go on in order to bring more and more and more oil on stream. It is not only oil companies that are actually feeling the pinch. We hear that there are countries such as Venezuela that are struggling. And they're even now saying that there's not even any soap in the shops anymore. And we're looking at bare shelves in Venezuela. Well, you know, Venezuela has got its problems in that they have got a very, very, how can I say it, a socialist approach to life, as they have done under Hugo Chavez. And you know, since he disappeared, then it's all being sort of kept on somewhat. And what we see then is that the situation in Venezuela is dire, is absolutely dire. And there's now talk that will the government default? Well, you know, they've still got pretty deep reserves. And so maybe it's a little bit unlikely in the short term, but it could happen. We could even get Russian bond defaults. And if we were to get any of those, if we get any sovereign defaults because of the low oil price, then it won't just be ripples, it will be big waves that start to wash through the financial system. So we've got some of those big concerns. So let's just now come down to look at some of the charts. And it's well worth just taking a little glance at, first of all, this daily chart of the dollar index. Now, as mentioned, that perhaps we could be getting close to an area where this dollar is actually going to correct. But have we seen any sign of it yet? No, no. Over the Christmas period, Christmas holiday period, then we found that the dollar just picked up some acceleration. And we've got these various areas where it actually bounced back. So let's just consider this from a trader's angle. If we go back to this, say, April, May, June period of time, then certainly in relation to what happened from midsummer onwards, it was just moving sideways. And then it absolutely took off. So what's a trader to do? A trader will get used to a market doing what it's doing over a period of time and spends most of the time just chopping up and chopping down. And what works really rather well when you've got a choppy market are things like the value finder oscillator. And whichever oscillator you actually use will tell you much the same story. That once price reaches an extreme on the lows, it's most likely to bounce back to the highs. And that is exactly what happened time and time and time again. So the game then is to use an oscillator. You look for the overbought and the oversold positions. You sell when it's overbought and you buy when it's oversold. Now that's an oversimplification, of course, because there are one or two other things involved that we do want to be looking at. We want to have a handle on price action. We need to know what the signs are when price is actually moving up from an oversold position. So we need to know that. We need to get a bit of an education on how to trade these things correctly. But then what happens when it moves into a very, very clear trend? And we know it's a trend because it's broken out of the previous little band, this channel that it was stuck in. Do we then use this oscillator? Do we sell, for instance, when we're here, and hope to buy back when it's right the way down here? Well, rather unfortunately, we don't find that this oscillator comes right the way on back down. So if we sell, okay, at the end of July, when the overbought indicator is suggesting that we should, we're not going to get back in. We might possibly be along here, but we are going to miss. We are going to miss this major run. And there's a truism that the big money is in the big runs. And without a doubt, this has been a big run. So what has the trader got to do? Got used to trading a trend, trading a range, and then all of a sudden it breaks into a trend. Well, what the trader needs to be aware of is the fact that that's exactly what does happen. And when it moves into a trend, we can still use this oscillator, but we've got to use it in a different way, and we've got to use it in conjunction with something else. And that something else might be moving averages. In my case, I just use this swing trend. Now, the swing trend is a little proprietary indicator that we use. And what it does, it's based on price, and it's based on how much price generally moves, and it keeps us in the long trends. So the question then is, when do we actually get in and when do we get out? Right, well, once a trend has established itself, and we know that because what we can do, we can put a line across. We can put a line across a range. And when price moves above that range and doesn't crash back into it, we're pretty well assured we're actually into a trend. And then what we can do is that we need to find somewhere to actually buy into this. And what we don't want to do, because we learned this when it was in range mode, what we don't want to do, we don't want to buy here. We don't want to buy here because it could crash down. So let's just put a little line there saying that, no, we don't want to buy there. But what we might want to do, we might want to just look at this oscillator, and we could just use a little line to just show us how this oscillator is picking out a high, just as if we're charting price. And once we've had a nice little ABC move on the oscillator, and price then moves back up, at that point, and breaks higher from that little range, then we can get in. Where is our stop going to go? Well, it's going to be just underneath this green line. What we can then do, we can just stay with it and keep moving our stop up just under this green line. And it's only when we get a close through this green line that we actually close the position. So any trader using this who managed to get in just stays with it, just stays with it. Now, eventually, and we never know this, eventually there will be a close underneath this green line. And that green line will then turn red, and that's when we get out. There are other ways of playing with this so that once we've got an established trend, we can actually add in. And what we can do is that we look for a peak in the oscillator, and we do this. We look for the next peak that there was, a lower peak, and we then wait for this oscillator to start to move up. And indeed, we can tighten this one up because we've got a very neat little high there. And as price breaks through it, what we can do, we can buy in that region. We can buy more. We will obviously have to be using our money management to make sure that we are preserving our profits as we go up. And then as price moves higher, we can move the original stop right the way up, and we can move it to just under the green line, and then we've got another position on, and we can do it again and again and again. Eventually, we're going to find then that the trend will actually change, and the chances are that when it does, we will have been sitting on quite a substantial profit, and we will be taking it at the right time. Now, that's just one way of trading a trend. And there are others in that we can take partial profits along the way, we can add in, and so on. And that's a process that we teach. And you can do this on a daily chart, and you can do it on a 30-minute chart. So what we need to do is to understand if price is moving in a trend, or indeed if it's moving in a range. And it's so simple to actually do that, but regrettably, the majority of traders seem to get locked in to wanting to trade in the way that they have been trading And market dynamics tell us time and time and time and time again that the market doesn't stay in trending mode forever. It tends to spend more time trading in chop mode, and the majority of traders do not know the difference between one and the other. And of course, we found that in the tech boom, which, yes, there were a good many traders who made a lot of money out of the tech boom, but equally, there were an awful lot of traders who ended up making a lot of money on paper, but in the final analysis, ended up going bankrupt. Purely because they didn't really know the difference between a strongly trending market and a choppy market. Right, so if we just look at this little chart of the euro on the daily, we can see that we had a substantial downtrend, and it came to a point where it started to move sideways and looked as if it was going to pop up. And the swing trend told us that we needed to be exceedingly cautious, and it just might be a good idea to cash in some of those profits and then wait for the next signal. And of course, the next signal did come, and since then, see, we've had another run down. Now, I just want to point out one other little technical feature that we can actually see in this chart, and that is that we've had a couple of gaps. Now, a couple of gaps are here and here. We move those just slightly closer together, and again here and here. Gaps are all important because there are three main types of gap. There's the breakaway gap, there's a natural gap, and there is an exhaustion gap. What we've always got to be careful of, where we've got a very mature trend and we start to get gaps, they could become exhaustion gaps. And exhaustion gaps will very often lead to a reversal that could potentially pop back. And a gap filling exercise could well take place. So we've got to be exceedingly cautious out there right now, because we could just be at a time when we're going to see some pretty substantial snapback moves. The most likely one to do that is the Aussie dollar. Now, the Aussie dollar, as we can see, this has had its move from the summer in common with the others, and the swing trend is intact, still intact. We've not actually had a close that has managed to push higher than it, and what just could develop, we're now picking up one or two harmonics in this region. What we just might want to see is that where we've got the euro weak, we've got cable weak, we then look for the stronger currency, and this is the stronger currency because it has not collapsed in the same way. We're also getting now divergence, and we've been getting divergence on the value finder for quite a bit of time. And most recently, we can see there that we've got the value finder moving quite neatly up, picking out a couple of points, whilst price then has been coming down. So we've got divergence, we've got strength against the other currencies, against the US dollar, and we've currently got something of a rally going on. Now, this is just a one-day rally, and so consequently, we've got to just not really believe what we see until something very, very clearly develops. Now, what will happen with a change in trend is this. This is the 4-hour chart. We've got a number of drives to a low. Harmonics are telling us that when it gets to these lows, we're most likely to get a bounce. We've actually had a bounce. And this has run through then from yesterday into today. And the next most likely thing to happen is that we will get something of a breakout of this move. Now, if we were to just run this channel line further on down, we just might get a breakout of that. Then we're likely to get a very deep pullback. And that deep pullback is likely to bring us down to this 8100 level. So I wouldn't be at all surprised if we're going to get more of a rally on this. It may find it difficult to actually break this high, but what we may well find is that price will break this line, but then it'll put in a deep pullback. If it can come back to this level and then turn the corner, that will be the signal to tell us that this one is then ready to move considerably higher. So what we then need to be aware of is that, yeah, we've had this sort of massive downtrend. And the question will be, is it going to move into a massive uptrend? The most likely scenario is no. The most likely scenario is that we're going to see it moving sideways, and consequently we'll want to move back into oscillator mode. And what we'll then need to be doing is to be looking very, very carefully at our oscillators, and we're going to have to look at previous highs and previous lows to see if this does stay within a defined range. And if it does, then we'll start to be selling when the oscillator has gone to extreme highs, and then buying again when it drops down to the bottom of that range and then bounces up again. So there we are. That, I think, is what is probably most likely to happen right now. I could be completely and utterly wrong. We may well find that this dollar index will just continue higher and keep going gangbusters, and it will do so absolutely immediately right now with not a stop. But the harmonics are telling me otherwise. We've got a false break reversal level that it's managed to hit, and the suggestion is that I'm putting forward right now is that we are highly likely to get, at the very, very least, something of a pullback, which could well put it into a trading range that could last quite a few weeks before the US dollar manages to pick up enough momentum to then move higher, as undoubtedly I believe it eventually will, up towards that 100 level. Right, okay folks, well I've put my assumptions on the line there right now, and what we've always got to be exceedingly cautious of is to not allow those assumptions to get in the way of what could be a beautiful little move on short-term charts. And we always seem to get those. I've come right down on the Australian dollar to a 30-minute chart. And we've had one or two really quite good moves. In fact, yesterday we had a perfect little setup. First thing in the morning, which turned out to be a breakfast trade, which actually ran for 2 days. So we had a signal that came in, and that signal got us in at this level. And the way we trade it is that we trade 3 contracts, or 30 contracts, or a 30p spread bet. Doesn't matter what the size is, depends on your account size. And so what we do is that we will buy, and once we get to a point where price appears to be reversing back on us, then we close 2/3 of it. When it then shows evidence that it's taking off again, we start all over again. We buy another three contracts. And when price looks as if it's going to come back on us, we close 2/3 of it. So we take day trading profits, and then we keep the one contract from the first position, the one contract from the next position. We get our stops to break even on those, and then we just let it run to wherever it's going to run. And it ran this morning up to this harmonic level. And that harmonic level, picked out by a couple of these lines on the software, in the right place, and it told us that look out, because we just might get a correction here. And so that was a reasonable place to then take one of those off the table and take the profits on it. And then move the stop up on the remaining one so that it's nicely in profit, because there's always a possibility that there might be quite a bit more in it. And so that is the way that we will move the intraday trade into a swing trade, by keeping a piece of the action still in the market. Now, at the moment, the Aussie is a bit of an each way bet, and it's suggested that as it has pushed lower than this higher low that there was in the during the Australian trading session, that it could well collapse lower. And so consequently, the stop is now at that level. It's just underneath the low that it actually formed a few hours ago. And if that stop is taken out, it will actually produce a very, very acceptable profit from the trade that was actually put on yesterday. Right. Okay, folks. Well, I've shared with you my views of what just might be about to happen, and ways and means of trading both longer term and shorter term. So if you're interested in any of those indicators and want to know more, then get in touch with me, get hold of Forex Trading for You, and I'll be only too pleased to work with you. Right, I think time's up, so I better say farewell to you right now, and many thanks for being with me this morning, and do have an excellent year's trading.